Understanding Job Lots, a comprehensive guide. In the complex world of finance and manufacturing, the term job lot serves two pivotal roles, particularly in the commodities futures market and within the manufacturing sector. This article aims to demystify job lots, explore their functionality, and shed light on their significance in enhancing market liquidity and accommodating unique manufacturing requirements. Definition of job lot. A job lot broadly refers to a commodities futures contract whose denomination is smaller than the usual standard lot for that commodity. For instance, if the standard lot for a crude oil futures contract is set at 1,000 barrels, any contract involving less than that amount would symbolize a job lot. Conversely, in manufacturing, a job lot denotes a custom job that deviates from the standard or typical production processes employed by a manufacturer. Key takeaways. A job lot is a futures contract for a quantity less than the standard lot. In the manufacturing context, it refers to non-standard jobs. Job lots enhance market liquidity by allowing smaller buyers to participate in commodity trading. How job lots operate in commodity futures. Commodity futures exchanges play a pivotal role in the global financial ecosystem by enabling producers and financial buyers to engage efficiently with commodities. Through structured agreements, producers can obtain the necessary commodities while financial buyers can manage risk through hedging or speculative activities. Standard contracts. Futures exchanges utilize standardized contracts to streamline transactions and facilitate high-volume trading. However, the size of these contracts can sometimes prove daunting for smaller firms or individual investors. As an example, the Chicago Mercantile Exchange, CME, has a futures contract for soybeans equating to approximately 136 metric tons. A small investor or buyer looking to handle a smaller quantity may find this overwhelming. The role of job lots. To mitigate this barrier, commodity exchanges often allow for smaller order sizes, recognized as job lot futures contracts. These contracts may allow for smaller denominations, such as 100 barrels of oil instead of the standard 1,000. By granting access to smaller market participants, job lots contribute to the overall liquidity of the marketplace, thus ensuring that all traders enjoy the benefits of rapid transaction times and relatively efficient pricing. Real-world applications of job lots. Futures contracts are predominantly standardized and traded on commodity exchanges. The designation of a job lot comes into play when a contract specified quantity is below the accepted norm for that commodity. To illustrate, consider precious metals like gold and silver. Futures contracts for commodities may be arranged in increments of 5 ounces. If an exchange agrees to enter a contract for a quantity lower than the 5 ounces, that contract qualifies as a job lot. Examples of job lot application. Agricultural commodities. A small farmer may need just a few hundred bushels of corn rather than a full standard futures contract. Entering into a job lot arrangement makes this feasible. Precious metals. An investor interested in acquiring silver might want to purchase 3 ounces rather than the 5-ounce minimum. A job lot contract permits such a transaction. Significance of job lots. 1. Increased liquidity. Job lots facilitate participation from smaller investors, thereby enhancing overall market liquidity. Increased liquidity contributes to less price volatility and more accurate pricing. 2. Risk management. For smaller investors or businesses, participating in job lots allows for more manageable risk. They can hedge against price changes without committing to larger quantities that could impose significant financial strain. 3. Market flexibility. Job lots introduce flexibility into the commodities market, enabling diverse participants to tailor their orders based on individual needs and capacity. Conclusion. The concept of job lots, though primarily associated with finance and commodities trading, extends its utility to various sectors, including manufacturing. By allowing smaller denominations in futures contracts and catering to custom manufacturing jobs, job lots play a crucial role in enhancing market liquidity and accommodating unique business requirements. Whether it's a farmer seeking to hedge against future crop prices or an investor looking to diversify their portfolio with precious metals, job lots provide vital avenues for engagement in today's dynamic market environment.